great to be here back again at the IVCA annual summit to talk about what investing and the investment climate looks like. We've got a great bunch of people here. I'm going to time them appropriately so that we can get more of a conversation going. We are going to link the macros with the micros as well and talk about each of their businesses individually, as well as the kind of dry powder that they're sitting on and what they intend to do. Why are we talking about buyouts? Because buyouts have been part of the investment strategy for men like we have here on the panel over the last several years. In fact, over the past decade or so, we've seen an increase in the number of buyouts. And, 2022 was a record year, and we've started to see an improvement after a little bit of a lull. We've started to see an improvement in 2024. The sectors that we are seeing controlled deals or buyouts happening in: IT, ITES, healthcare, manufacturing, retail. There's a whole bunch of them. But the outlook continues to look strong at this point in time. So without further ado, Manish Kejriwal, I'm going to get you to start with the macros. As we look at 2025, let's first talk about the global trends that could shape investment strategies in India. Your time starts now.
Thanks, Shereen. Great to be here. Good seeing you again. I think a month ago when we were all in the Alps, the two themes or two topics people talk about was Trump and AI. And I'm just saying that because I think while that's not an investing theme, what the two of those things happen will really influence a lot of the global investors going forward. I think going back to global trends, if you look at it from the perspective of GPs, it's been an interesting year, 23 and 24. I think the biggest takeaway, if we went back to the Investor Council that we had a month ago, was a real lack of DPI and money going. So there was a significant shortage of liquidity, money being returned by GPs to their LPs, which is not good news, given the state of the markets. And because of that, a lesser degree of investment by global LPs into the asset class because there was a lack of liquidity. I think India is in a very different place. I think we're in a secular uptrend, barring the early stage VC when there was a slowdown given what happened 2 years ago. I think we'll see that come back. But if you see this as a representation of the dry powder, even all of us, despite being price disciplined, are stepping up and paying and acquiring assets where we have a high degree of conviction. But the bar is that much higher. And what's helping us is the DPI story out of India, which was a disaster 15 years ago, is today the one thing which is most appealing, not only vis-a-vis the rest of Asia, but as far as the rest of the world. Because we have, exactly, booming IPO markets, which has been actually the exit from the majority of all our positions. But in addition to that, a significant amount of dry capital, as we said earlier, for sponsors. And India being globally relevant, whether it's China plus one, given what's happening to the Ukraine and the Middle East, it seems like even the strategics are refocusing on India. So exits, IPOs, of course, but in addition to that, the financial sponsors, because of all the dry powder we have and because we believe in India, and in addition to that, the strategics. So as a promoter or a GP which controls an asset, our exit options for the first time are multiple and very attractive.
Multiple and very attractive. And I think that has been the change as far as the story is concerned. And we've seen that accelerate, especially in the last few years. Vivek, let me come to you to draw the macros and the micros. And let me start by asking you about the global outlook first before we talk about India specifically. To take forward what we heard there from Manish, what will be the trends that could potentially shape investment decisions and investment strategies globally, which could have an impact and a bearing on India?
What happens in the US matters for what happens in India, right? And I think there are probably three things I'd highlight. Number one, if you just look at where buyouts have gone in India, there's been increasing concentration from about 55% to 75% into three sectors: financial services, IT, BPO, and healthcare. And we suspect that will actually only continue to increase for very important reasons. These are often family-owned, They're often available for sale. You're effectively buying out other people's equity and capital. They often don't require cash, as much cash for growth, other than M&A and platform opportunities. So that's one trend that we definitely see persisting, is companies who produce great cash, whose balance sheet can be well managed, and whose equity stakes are available for sale. Those three sectors offer a lot. The second is, we actually do believe that the risk-reward returns for buyouts, and all the LPs do understand this, risk-reward has really favored buyouts over the last cycle.
Okay.
What you'll find is, if you look at large growth, large buyout, small buyout, pipes, and other forms of, effectively what you'll find is that on a risk-adjusted basis, buyouts are outperforming. And it's fundamentally, our belief is because buyouts help you reduce beta in many specific ways, not just how you allocate, not just governance and how you allocate capital, but it also allows you to control exit timing. The third trend, and this is where the US, by the way, people are nervous in the US about this, and in India, hopefully the party will continue, is if you look at buyout specifically and the MOICs, right, on exit, buyout, just other sales to sponsors for buyout companies delivered about a 2.8 MOIC. Sale to public markets at the time of IPO, 5.1. And sale to public markets a year following, 4.8. In other words, a huge amount of the outperformance of buyouts has been route to exit, and that is dependent on how buoyant the capital markets stay. And that's something actually in the US, which has actually been a little more muted.
Yeah.
So as long as the IPO market stays open, we should continue to see great exits.
Deepak, let me understand from you, your plans on how you see the global environment and what that could potentially mean in India. I know that you believe that you've only just gotten started in India. This is a landscape that is ripe with opportunities and possibilities. Take me through what the India story to you means today.
So let's start with the global allocation, right? So broadly, global allocation, there would be a bias towards US. There would continue to be a bias towards US. There is a lot of volatility associated with US, but that's a market that would continue to outperform. Focusing on India, I mean, this is our core market in Asia. We have a multi-asset class view here: infrastructure, private equity, late-stage growth. And I think infrastructure has started to mature for us a little bit. Private equity and late-stage growth have only just started. I mean, a lot of people, when they look at us, they look at broad pool of capital, but what they don't understand is a really large GP. Almost 80% of our assets are managed in-house, especially in India. Last 9 transactions that we have done have all been direct. That doesn't mean we don't partner with our partners like Kedara. We continue to do that, and that creates a right to win. But continuing on across the 3 sectors: IT services, financial services, healthcare. Healthcare, the journey is only started, right? Like he's talking about like being a second largest chain, but the reality is in India, corporate chains are still 12%. So corporate and regional chains like Sahyadri, which we own, are only 12% of overall hospital beds. So it's a multi-decade consolidation journey, and there are several such multi-decadal journeys that are existing in India that we'd continue to focus on, drive, and move forward.
But Sumeet, let me come to you now and talk about your journey here, specifically from a buyout perspective. How do you see India? What's the outlook for 2025? Do you expect 2025 to be a significant accelerator over the previous year? What's driving the needle today?
Yes, so I think as a firm, we focus on mid-market buyouts, buying businesses which are usually $5 to $30 million in EBITDA and less than $300 million in enterprise value. I would say over a 10-year period, the supply of businesses that are available for sale has exponentially increased for multiple factors.
Right.
Being succession planning, spin-offs, global firms looking at partnerships in India. And also, there are 2 key themes I think that we have worked on. One is the global partnership model. I think a lot of Fortune 500 companies, to succeed in India, sometimes appreciate having a local partner, and we have done it 3 times over with Iron Mountain, Yum Brands, and Amazon. And the other theme, which is a very proven playbook in US and Europe, is consolidation of fragmented industries, where industries are fragmented, but each player makes money because the industry structure is very disciplined. And there with scale, I think margin improvement to growth to upgrading management and eventually multiple expansion all plays out. So we have done that 8 times over. So I think that theme of lot of industries in India are still fragmented. I think that consolidation play opportunity will continue. And with public markets getting little subdued compared to 24, I think there is a pool of businesses and shareholders which are looking for liquidity. So deal flow, I think in the next 12, 18 months should accelerate if public markets stay the way they are as of now.